today from farnsfieldresearch.com. Please.
Good afternoon, everybody. My name is Brandon Fargo. I'm here with Farnsfield Research. We work with Russell Sands, one of the original turtle traders. That's what we're going to be covering today, actually all 4 of his strategies. And then like you guys saw in the email, we actually have an extra promotion, and I'll get to that at the end. But we'll jump right into it. Let me go ahead, go on down. So that's me. And that's my beautiful girlfriend. I am an entrepreneur. I own several different restaurants. I've been working here for quite some time, but before I worked with Farnsfield, I was actually in real estate and development, built spec homes, corporate type buildings, and did custom homes. And when the bubble popped in 2007, I had to go looking for a new career and a new industry, and I moved out of real estate and started investing and trading, and that's how I got hooked up here with Farnsfield Research. I've been working and trading with them for over 9 years now, and you know, they say when one door closes, you know, multiple open, and that is the truth of the matter, because they've really opened up my eyes to different avenues of investing and trading. I'm sure, as everybody here knows, there's a lot of money to be made in the markets, and I definitely found that to be true. There's Russell. We've been working with him for a number of years. Russell Sands is one of the original turtle traders. I'll give you guys the Cliff Note version because we've got a lot to cover. But back in the 80s, there was basically an experiment conducted between 2 commodities brokers and hedge fund managers. They hired 14 people and taught them their method and handed them each $1 million to trade with, on the belief that you could literally take anybody off of the street, no matter what their background was, and you could teach them how to trade successfully. And this was all done on $1 million bet as well. And so they stuck these guys in a room across the Chicago Board of Trade for 2 weeks, trained them their method, and then handed them each $1 million to trade with. And Russell Sands was one of those guys. Every single one of them was successful. They all made money. Some made more than others, but where the real money was made was, you know, whoever was the most disciplined, which Russell was one of the most successful traders in that group. After about 1.5 years, he left the group. Russell's got a real good background. He's got an MBA from NYU, put himself through college as a cab driver, but was real disciplined. He was actually a backgammon and blackjack player, and before he was a trader. So kind of taught him the discipline and removing emotions out of trading, and that was a lot of help to him. Since then, I mean, he's been trading successfully for over 35 years. He manages a hedge fund that does quite well, and then trades his own personal money as well, and teaches people how to trade still. And that's what he really loves. He has a passion for teaching. We're going to be going on tour this year, and I'm going to talk to you guys about that here in a minute. But he actually has 4 different programs that he does offer, not only in commodities, which is where the original Turtles method was built, but also in index futures, where he created a hybrid on a shorter term time frame that trades the S&P, the Dow, and the NASDAQ. And then also in the foreign currency market, where he trades the 8 major pairs, and that does quite well. And then most recently, we have his option strategy, which under the current market climate is just knocking it out of the park. So we do have a lot to cover. I'm going to ask the audience that if you guys do have questions, please hold them till the end, and I'll try to get to everybody. And if I can't get to everybody's questions, you can email them or you can call us here, and I'm happy to answer them at that point. Okay? So let's jump in. We're going to start off with his commodities program. So this is his staple product, and where he has been the most successful for over 30 years. It's modeled off a $1 million portfolio, but you do not need $1 million to trade this. You can literally start off with as little as 10 to 15,000. The strategy trades, buys and sells a wide range of 50 different commodity markets, such as currencies, grains, metals, oil, gold, silver, so on and so forth. Takes advantage of market fluctuations and volatility. When the markets have a clear direction of a bull or bear market and there's a defined trend, the system will identify these movements and normally see big gains, which is what the strategy does. I mean, Russell's what you would call a long-term trend follower, okay? So he's looking to hold positions in the commodities markets for long periods of time and take as much out of a trend that's possible. And we'll get into some of the technicals and the entry strategy here and how he manages risk, which is the most important part of it all. He uses about 15 different indicators, looking at moving averages over a 15-day mark. We're looking at 21-day bar charts and channel breakouts. So basically, as far as the entry strategy is concerned, what he is looking for is a 21-day breakout, either to the high or to the low. So if a new high or a new low is created within that 21-day period, that's going to signal a breakout, and we're going to take that trade long if it breaks high or short if it breaks low. So this is not something that is extremely active or in and out of the market every day. Depending on how many markets you're trading, on the smaller accounts between 20 to 50K, you're probably going to be seeing, I would say, 6 to 8 trades a month. Okay, and those usually hold positions on average for about 3 to 4 weeks, and then sometimes longer if we hit bigger trends. In 2014, when crude oil was tanking, we shorted crude all the way from $90 a barrel, somewhere in there. I think it was like 90 or 95, all the way down to about 30. That one trade, and we took every rollover in the midst of that from September all the way till March when it finally bottomed out. So that was about a 6-month-long trade. But not everyone is going to be like that. Again, the average is about 3 to 4 weeks. As far as the risk management is concerned, the way he calculates his stop loss per position is with the average true range or the daily true range to determine what the normalization or the normal market range of that particular asset is at that time. Obviously, the market can be ranging at different lengths, depending on what's going on in that sector or overall in the markets. So, I mean, silver might have a 10-point range today, and then 6 months from now, a 5-point range. And the reason why he uses that is he doesn't want to ever hold excessive risk in any one market, which I'm sure everybody in here can agree with. Again, it'll hold positions for about 2 to 4 weeks. We talked about that. It has different size commodities to trade. So the biggest example and where a lot of people start off with is a 25K account size. You'd be trading 9 commodity markets that Russell recommends. Corn, the mini Dow, mini euro currency, lean hogs, natural gas, orange juice, and sugar. Sorry guys, we put euro in there twice. But you guys get the gist of it. So the strategy is a solid strategy. It's been around for years. A lot of people have said that trend following is dead, and I can assure you that it's not. And we're going to go over some open positions right now so you guys can see what's going on over the last couple of weeks, especially after this election cycle. It's been pretty exciting. We've been making a lot of money here, so I hope everybody's been doing well with the new volatility. So here's an example of a trade. This was on soy meal, okay, 4/11/2015. We exited on 6/21. I wanted to show this one because it had some good length in it, and you can see kind of how we enter the market here. So we entered back here on the 11th of April, which again was a 21-day breakout, okay? So, and I apologize for the charts, guys. Only thing I could get was the open high-low bars. But you guys, it'll detail exactly what we're looking at here. But as soon as the market broke out, we had our entry order in here. I mean, every day we know exactly where our entry and our exit is. And going back to what I touched on earlier, that's where the real success in trading is going to come from, is that discipline, number one, and number two, having a set strategy and knowing how to enter and knowing how to exit and having those rules planned out and following that to a T and not getting emotional when it's not working. And that's where 90% of traders go wrong. We actually have a term in the industry that's called the 90-90-90 rule, where 90% of retail investors lose 90% of their money in 90 days. And it's not because they're not smart or they don't know what they're doing. It's more about the emotions. So this has a set entry strategy. It never deviates away from it. And we take it for better for worse. And we know that it works because over the last 30 years, it's proven successful and averages well over 100% a year. So you can see the breakout here. We took that and we followed this trend for quite some time, almost, over 2 months, and, you might get a little bit nervous in here when this spike comes down. But again, if we're following the rules and following the strategy to a T, we know how our exit works, which when you guys subscribe to the service, Russell does give you full disclosure. So all the money management tools, all the rules are given to you up front, or you're actually able to receive the signals to your email every day as well, or set it up for complete auto trade. So it can be completely hands-free. That's up to you guys how you want to utilize the services. So this total, we gained about $11,000 per contract traded in one trade, $11,640. The margin that was required was only $1,800. So the return on margin was over 650%. Pretty impressive, right? Now, obviously, not every trade's going to be like that. Not every trade's going to last that long. But the way that the strategy is designed is to be able to take advantage of these trends. And you'll notice here at the top, you are always going to give back something at the end. But allowing that market to continue to move and following those rules with a trailing stop, okay, you'll be able to capture the lion's share of any given trend that happens in these markets. Let's go on to the next slide here. Okay, we're actually going to start covering his balanced trader program, which most of my clients, you can trade it individually. Most of our clients will trade this with the commodities. It's a great add-on. It trades the S&P, the Dow, and the NASDAQ, okay, all the mini contracts. And to trade all three, you would probably need margin of about 15 to 20K in the account. It's a position trading system. Like I told you, it holds on the S&P, the Dow, and the NASDAQ. And this is a little shorter term. So we're not in positions for as long as the commodities. Where the commodities where our normal range is about 3 to 4 weeks on a trade. With this, we're in positions for about, I'd say, 1 to 2 weeks. So it's looking for those smaller inflections in the market, or where we can get in, grab some profit, and get out. We don't try to predict the market. I'm going to touch on that here in a second. He uses specific technical signals, entry rules to spot overbought and oversold conditions. So that's where the balanced trader differs from the commodities, where the commodities is purely a breakout strategy and we're trading on price. The balanced trader does add in those overbought and oversold conditions to take advantage of some of the market swings. Whoops. All right, we always have stop loss in place. Again, that's determined by the average true range. 2 chart indicators on the entry and 2 on the exit. So we know how to identify, the emerging trade. Again, it's 100% technical, and when those are lining up, we'll get into a trade. We trade less than 1 hour per day, and that's why you don't have to watch the markets all day. And again, that's going back to every single day. At the end of the day, we know exactly what our entries and our exits in, and you can simply put in your limit orders and then go about your day. It's extremely simple. A lot of people think and that you have to sit there and stare in front of a computer all day to be a successful trader, and it's not the truth of the matter. You can simply set your orders if you have a set strategy that's based on price like this and still be successful. And that way you don't have the stress of it. And going back to why we don't try to predict the market, Russell will be the first one to tell you that he does not know where the market's going. He doesn't care. He doesn't listen to the news. He doesn't listen to or make trades based on a fundamental indicator or anything like that. We're looking strictly at technicals, strictly at price, and following that to a T. So, for instance, we were during the election cycle, a lot of people were probably shorting the S&P beforehand or going long the S&P before the election, and they probably got murdered. Trying to predict it and trying to figure out based on what Fox News or CNN was saying or CNBC. Whereas with Russell, we simply put entries orders in, and made some good money. And we're actually going to look at some trades, especially on his options program, where we were able to take advantage of some of the movement post-election. So covered that. So here's a few trades actually on the S&P 500. Okay, September 2016 contract. You can see we had a buy on 5/27/2016. That's here again. I apologize for these charts, guys. They are horrible. And we actually got out of this trade, okay, real quick. Knew he was wrong. The market did, if you can follow along, the market did pop up, gave back, and we exited early. Now, we did re-enter down here, and this was basically an oversold condition, okay, and we rode that trade all the way up. We got taken out of our profit target, which this has a 2-time stop profit target. But then we re-entered the next day as the market got sold off again and took that trade up. So total between these 3 trades, you would have gained a $5,400 profit, and that's in less than a week. Okay, so on a 20K account, that's a 25% return in a couple of weeks. Not too bad. Let's go here. These are some current positions. Now, this includes both the commodities and the balance trader, okay? Again, a lot of clients trade this in the same account on the auto trade because it does not cross paths with the balance trader and the commodities, because you can trade the indexes with the commodities program, but that's on a longer term basis. So the two really complement each other. While you're looking for longer term trends on, let's say, the Dow, the S&P, or the NASDAQ with the commodities, on the balance trader, you're looking for those shorter term inflections, a couple of days to a week or so. So you can see, this is yesterday, by the way, and the reason why, and I'm going to show you today as well, but we did take profit on, or rolled over this gold contract, which was a $2,200 profit, and when we rolled it over onto the next, into the February contracts, we were down 257 yesterday. I'll show you where we're at today. But you can see we're in soybeans. We're up about $535. We're in soybean oil as well. That one's kind of flat. We're down on the feeder cattle, about 348. We talked about the gold. We rolled that over, took a $2,200 profit, but then we're down 257 on the rollover. On the sugar, we're up 930. Gas was pretty much flat. On the platinum, 255. And on the S&P 500, as you can see there, we're up about 2,100. Now that is on the balance trader program. Okay, so we've been in that position. That's the price date. It doesn't give me the entry on this for some reason. I don't think that long. I think that's only been a couple of days. So you can see the mini euro. We've been in that, and we are up 1356. Okay. So as of yesterday, the open trade equity was only $4,700. Plus you had that got credited to the account. Now let's go to today. This was just this morning. I printed this off. You can see the soybeans gave back a little bit. Soybean oil popped up. Feeder cattle came back. The mini gold came all the way back $400. So we were down 257. We're gained 479 today. Now total net, we're up 222. Or excuse me, I was looking at the wrong one. That was the gold. Yeah, we were down on the rollover. Same with the feeder cattle. That gained 725. Now we're up 377 on that. The sugar, we're up 762. The gas, 75. Crude, negative 60. Platinum, 675. That's a newer trade. Got entered today. S&P 500, we're up 2050 on that. And the euro, we're up 1656. So total net profit on open trade equity is that $6,000. Okay, and all of these trades happened within the last 1 to 2 weeks. So not too much, not too crazy. I mean, you can see trends that'll give you $5,000, $6,000, $7,000 per trade and per contract traded. But in a market like this, where we're not seeing those, 3, 6, 8-month trends, it's pretty good. It's doing pretty well this year, even in the choppiness, and we're seeing some good success. Let's go on to the Forex. Okay, and again, we'll take questions at the end. The Forex strategy, he created a hybrid some years ago, back in 2006. It trades the 8 major currencies. So the Euro USD, the Pound USD, the USD Japanese Yen, the Swiss franc, the New Zealand dollar, the Pound Yen, the Canadian dollar, and the Aussie dollar. So the 8 majors. The reason why Russell likes those is they're obviously the most liquid, with the Forex, that can be issues, especially with some of the bigger news events. So that's why he trades the 8 major currency pairs to make sure when these bigger news events happen that we don't get slammed. It usually takes about 3 to 6 trades per month, and it holds positions for around 2 to 4 weeks. Again, sometimes longer if we hit some of those bigger trends. But the money management is a little bit different on this. It does take profit a lot quicker, even though we are still looking for those longer term trends. The exit strategy is a bit different from the commodities and the balanced trader. Also, what's different is rather than just having a pure entry based on a 21-day breakout, he also utilizes the 150-day moving average to help him determine what direction we're trading in. So if the market is above the 150-day moving average, we're only trading long. If the price is below the 150-day moving average, we're only looking for shorts there. And the reason why is because with the Forex, obviously, there's a lot of manipulation involved, and trends can be, or false trends can happen. A lot of false breakouts can happen if you're on the wrong side of that moving average. So we do look for that directional bias, and we stay to it. He uses about 3 to 5% allocation per trade. Okay, so he's not, and the most trades you'd ever be in is 8. So no more than 40% of your account would be allocated, but that's not the risk per trade. Again, he always has stop losses in place to protect from any major adverse moves in the market. Same as the commodities, we're looking for a 21-day breakout. Okay, so a higher high above the 150-day moving average, or a lower low below the 150-day moving average, depending on which way we're going. Okay, covered that. Stop points, risk management. He uses the average true range to determine, again, what the normal range of that market is at that time. Some years the euro might be ranging at 40 to 50 pips. There's no point in putting a 100 pip stop in place if the market's normal range is only at 40 to 50 pips. And there's no point in holding that excessive risk. This also, the range does help him determine how much risk per trade to put in. So as you know, with the Forex, you can really determine what your position size is. And so the range of the market and the volatility of the market will help determine that. But again, Russell does cover all this in his courses. You will be able to learn that from the course. We send out a DVD where we held a seminar about 6 years ago, or maybe it was 7 now, where he taught this in a live classroom, so you do get that. Or you could just come to our seminar that we're hosting this year, and I'll talk to you guys about that here in a minute. 12 to 15 major indicators which pick out when these trends occur. All right. So here's a trade. This is on the pound US dollar. Okay. This was a 21-day breakout. 150-day moving average was up here somewhere. This was on the September 16th of this year. Okay. We got in at one spot 30200, and we covered a couple of weeks later, about 3 weeks, at one spot 242. So quite a big move. You can see that we rode that all the way down. The market did go lower, but then pop back up. Okay. As this trend continues, you know, at first we leave the stop depending on what the ATR is, but then it starts to get real tight against the price of the market. You know, and a lot of people get nervous, especially with the Forex, because of how fast it moves. But with the set rules, I mean, you know, again, we're following that to a T. And we got stopped out here a couple of weeks later. So our entry would be, you know, after the market normalized, we would take a re-entry down on the next low. So if the market came back up and then popped down, we would take that on that low there, because that would be the new 21-day low. All right. Here is some open positions that have been open for a couple of weeks now. You can see here we're in the dollar Swiss franc right now. We bought it, so we are long. We got in at 0.999989, and right now, currently, we are at one spot 01176. So floating profit and loss, and this is only trading 3 minis, by the way. You would have made about 351 so far. And then here you could see on the US dollar Japanese yen, we bought this as well at 109 spot 76.8, and the market's all the way up to 112 spot 44.8. We're up 715 on 3 minis. So you can imagine what a standard lot would have done for you on this. You're up close to, what is that? Almost 300 pips on this move. Floating profit and loss, you're at about $1,000, okay, on 3 minis. So small amount of risk here. Russell recommends, you know, again, depending on what the volatility is, but he usually recommends trading 1 micro per 1,000 in the account. So that's a 1-to-1 leverage under the current market volatility. Now, I do have clients that trade at 2-to-1, 3-to-1. That's up to them. Some do a 5-to-1 that are trading this on their own. That's up to you. You can also layer into positions. So, I mean, it really depends on what you'd like to do with it. You know, but Russell does recommend that 1 micro per 1,000 in the account. All right, now we're going to cover the options, okay, which is his newer strategy. He started doing research on the options about 5 years ago. Basically what he did is he took the original Turtle rules and he applied them towards the ETFs, exchange traded funds. Over 60 are looked at and monitored. 37 specific ETF markets are preferred to trade. So we're looking at about those 37 out of the 60 that we monitor, but looking at 37 more diligently. But that does not mean you have the ability to be in 37 trades at a time. Okay, we only use, on average, about 5% allocation. So that would basically be $250 for every 5,000 in the account. And no more than 6 trades at a time, and about 10 trades a month. So this is not super active. Usually in and out of the market pretty quick as well. He holds positions about a week to 2 on this. On the trade alerts come out during market hours about 30 minutes after opening bell. And the average monthly return is about $2,100 or 259% annualized. He's buying straight calls and puts, so just directional. The exits, even though we have a defined exit strategy, if the market moves against us 50%, or I should say, if the option value decreases by 50% of our entry price, then we're probably going to be getting out of that trade real quick. Trades can occur at any time during the day. New trade entries can easily be done after the market has been open for 30 minutes or so, but overnight news can cause some of the bid and the ask spreads to be very wide during the first 15 to 30 minutes of trading. So it's basically we wait for the market to settle after the open and then put our limit prices in so that we get a good price because 10 cents on an option can make the world of a difference depending on how many contracts you have. Again, all he did was take the original Turtle rules and applied it towards the ETFs and is buying straight out options on it. So this is on KRE, okay, which is the regional bank fund on the S&P. Now this is the day after the election. You can see this big spike up right here, I believe. Yeah. So November 11th, or excuse me, I think the 11th was the first day of trading. Anyway, the day after the election, we hit a new high on a 21-day bar chart, okay? This one was a little bit tricky getting into because when you woke up the next morning, I mean, the market was all the way up here, and we wanted the 44 calls, okay? So he had a few different entry prices that could be possible for the trade, and we usually want to buy at the money strike prices of where that 21-day breakout is. So we were looking at the December 9th calls, the December 16th calls, the December 23rd calls, which were at about 163 for the December 9th, 212 for the December 16th, and on the 23rd expiration, they were 261. Now we also were looking at the 45 calls, and those were a little bit cheaper, but not by much. So an average turtle trade, since it lasts about 17 to 20 days, so about a week to 3 weeks, we prefer options that are priced at 50 cents to $2. Sometimes he will trade as high as $2.50, okay? So on that morning, there was no real trading activity on the December 16th expiration. There was more trading activity on the December 16th expiration. So that's why he chose those calls. He got the 44 calls at $2.12. So he had chosen more expensive. He could have chosen the more expensive December 23rd expiration, and we would have had to have tied up much more money for that than was necessary. So the actual trade, we put in a limit at 230, and that was the call, and actually got filled at about $2.12. So it was a great trade. We got out on the 25th of this month, and we closed at $8.25. So you would have made about $600 per contract traded there. So if you were trading a $10,000 account using $500 per trade, you would have had 2 contracts there, or based on what he recommends. So you would have made about $1,200, and so on and so forth. Let's go down. These are the current open positions, okay? And this actually shows that KRE trade. So that one's actually closed now, guys. Sorry about that. This was printed off, I believe, 2 days ago. We're in GDX, so we're short the gold minor vectors ETFs there. We got 3 at 229, and the market was at 192, so we're down $113 on that. KRE got out at 1684 with 3 contracts. This actually did pop up a little bit further. At the time that this was printed off, it was at 777. I know we got out at 825, so you would have made a little bit more there. On the XLF, we are still in this trade. You'd be up about 512. And the XLY, which is a newer trade. We have 3 contracts on that, and you'd be up about $120. Okay, so here's your cost basis of the premium you would have paid to hold 3 contracts on there, and the value of those options when this was printed off, which left you with a net $2,200. So that's a 22% gain in less than 3 weeks there. So it's a phenomenal strategy. It really has benefited a lot of our clients and been a real complement to the Turtles portfolio, because while we're looking for longer term trends with the commodities and the Forex, and then you do have some short term stuff with the balance trader, the options is more about singles and doubles. So our average drawdown is about 26%, and your average losing trade is only about 2%. Or excuse me, the max drawdown was 26%, and your average losing trade is only about 2%, whereas your average winning trade on the options is about 6%. So you're at about a 3-to-1 risk-reward ratio. And it wins 1 out of every 2 trades, which, normally with trend following, you're only going to win about 30 to 40% of the time. And you've got to have that high risk to reward, meaning your winners really got to weigh out your risk while you're sitting through sideways choppy markets. Now, what's great about the ETFs is that the ranges aren't that big. They're extremely tight, and so we know we're wrong really quick and can get out of that trade. And we're not holding these positions for long. He's buying these calls and these puts about 4 to 6 weeks out of expiration, and usually holding them about 1 to 3 weeks. So short-term trends and just trying to capture that volatility in the market. Any questions on the strategies at all? I know we've covered a lot, so all right, none yet. So let's go on, and we're going to talk about the Turtle Tour, which it's a seminar you cannot afford to miss. Okay, here we go. So you execute on daily only or intraday. So Tom, he's executing daily, but some of the orders can be entered intraday. I mean, everything is done by limit order. So every day when you wake up, the way that the service works on the commodities and the futures, and then also on the Forex, the orders come out the night before. And you'll get a list of every market that Russell trades, all the entries, all the exits, and you can input those into your platform. Now, if you're learning this, which with all the strategies you do get full education, and Russell sends all the information that you would need in order to learn it, and then you can work with him going forward in learning the strategy. So if you're going to be trading this on your own and you do learn it, like I was saying, you're literally going to know what your entries are the day before, because we are entering on those new highs or those new lows. And you know what your exits are and what your profit targets are. But Russell does send those out every night between 5:30 and 6 Eastern. And for the auto trade brokers, they would execute on your behalf. Now, there's multiple brokers that you can set up with for the auto trading that are already accepting this for their clients and trading this for their clients. Or you can set up with your own broker and have the emails sent to them. So that's up to you guys, how you want to set that up. But the way that works is you have your own account, and they accept the signals for you and execute on your behalf, meaning the second that Russell's in a trade, you're in it with him, and the second that he's out of that trade, you're out of it with him as well. There we go. So getting back to your question, Tom, it's based off the daily charts. So we're looking for a 21-day breakout to the high or to the low. That's on the commodities. On the balance trader, it's a shorter time frame, usually about 9 days, but we're also looking at overbought and oversold conditions there. And then for the Forex, it's a 21-day breakout along with the options. So again, you're not sitting in front watching hourly candles or 5-minute candles. He trades based on price. It's extremely simple. We're basically looking for that move to be established, and then we tack onto that trend for as long as we can go. So, and the exit strategy is very defined. There's no question of if I should or if I shouldn't get into a trade. And that's really what separates this, as opposed to other strategies and other so-called gurus out there. I mean, I've been in this industry for about 9 years, and I can guarantee I've probably looked at everything you guys have done, and more. A lot of these strategies out there, a lot of these so-called gurus, it's really left up to you, and a lot of them aren't real. They're not even trading, and there's no real defined method that's in place. With this, there's really no thinking to it. It's all based on price. The only part that has discretion is the options. And with the options, it doesn't have to do with entering the market. It really has to do with, the open interest and the volume. And he has certain parameters that need to be met there as well. So even though I said there's really no discretion involved. But again, Russell will teach you all of that. And that's the other thing. Russell doesn't charge extra for that. It comes with it. So whether you take advantage of the education or not, it doesn't cost a penny more or less. But if you do take advantage of the education, it's full service. You get the full trading manuals, and then you get to call in. You can talk with Russell or his trading team, and they'll teach you the method. So and it's really not that difficult. These guys learned it in 2 weeks, and he's been successful for 30 years. He's worth about 50 or 60 million bucks. Lives down in Boca Raton. Sets his trades in the morning, does his work, and then relaxes. So it's not that difficult. Is there a specific strategy you recommend? All of them, Jerry. I recommend all of them. So, I mean, to dig in deeper, I mean, diversification is recommended because while one might be in drawdown, the other one is going to mitigate that. Before the option strategy, Russell only had the 3. We used to call it the 3-legged bar stool. And I used to tell people, what happens if you're sitting on a stool with only 2 legs. So I guess now it's the 4-legged table. A 3-legged table isn't really going to stand up. But yeah, you want to make sure that you've got proper diversification because, again, the markets are unpredictable. All these guys on CNBC who are telling you it's going to go one way or the other, they're probably giving you 2 points of view, and then when it happens, they say, see, I told you so. And Russell will be the first person to tell you that he has no idea of what's going to happen in the market. But he follows the strategy, and the strategy works. That's the bottom line. In 2008, our clients did 500% in the currency market, 600% in the commodities. Russell took his $1 million and turned it into 6 that year. So, and he didn't see it coming. Nobody did, but he followed the strategy and it took advantage of it. Is there difficulty getting in and out of trades with all of us in the program? No, not at all. And we do limit the number of subscribers that come into these. Each year we'll get a set of people in, and eventually he'll just stop marketing it. But with the liquidity of the markets these days, especially since everything has gone overnight as well, is tremendous. The trading is no longer done in the pits down in Chicago. It's all done through, supercomputers and servers and through people like you and me sitting here in front of computers rather than, a select few people on the floor calling out trades that were called down to them from offices. So the liquidity, especially in commodities and futures, has grown tremendously. The Forex is a $3 trillion a day market. As far as the options go, the liquidity, if we get a signal on a thinly traded option, he doesn't take the trade. And that's why, we're looking at 37 different ETF markets, but at most we're only in about 6 trades at a time because different sectors can be, the volatility and the volume in those sectors can be different. If we were talking 3 weeks ago, the S&P was dead and flat and there was no volume. but after the election, the volume spiked, and we've been seeing a lot of action. So can you apply this method to day trading? You probably could. I've had a lot of clients who are professional traders or traders just like retail guys, just like you, and they worked with Russell and took the original rules and shortened the time frames and worked with it on day trading. I mean, there's breakouts and there's trends following, or there's trends happening every single place you go. Now, the strategy that you're going to learn is built for, they're basically position trades and longer term trades. So, but you can apply it towards other markets and other time frames, and it'll definitely work. It can be auto-traded, or you can trade it yourself. Most of my clients, the majority of them, do have it auto-traded. Even if you're going to learn this, you may want to have it auto-traded up front so you can be making money while you're learning it. But regardless, you'll receive the signals to your email every day. You'll know what the entries and the exits are, and you can trade it on your own. So you don't have to do the auto trade, but most people do, which is a shame because Russell does enjoy teaching this. He loves to teach people. It's one of the reasons why he's still in the game, and that's one of the reasons why we're doing this tour this year. So we're really excited about it. The next location is going to be in Los Angeles, and we've got a special treat for everybody on the webinar. Talk a little bit about it. You're going to get exclusive access to Russell Sands for the tour, and you're going to get 4 turtle manuals filled with step-by-step instructions on how to trade the turtle way for each of the following markets. You'll get the commodities, the balance trader, and the turtles forex, and the options. So you'll get those. The bonus is if you register today, you're going to receive 60 days of actual trading signals that Russell takes on his own personal accounts. Each trading day, you'll receive exclusive access to the following from Russell directly. You'll get the signals that are updated nightly for the following day, or if it's the options, you'll get them in the morning. You'll get the open trades and filled orders. You'll get the entry, exit, and protective stops, and you'll get the risk and the profit targets. Thank you, Kathy. Kathy just put a link in there. You guys can go and register in the chat room there. You can see it, finalturtletour.com/register. The pricing is going to be pretty significant for you guys. We're giving extreme discounts. The early bird pricing is normally about $2,000, $1,995, and that's if you register by January 15th. After that, February, it goes up to $2,495, and then up to the day of after that, after the 15th of February, it's $3,000. Now, don't have a heart attack, because everybody that registered for the webinar, okay, we're slashing prices. You guys are only going to get it for, or you'll get it for only $997, okay? And for anybody that subscribes to one of his services, okay, you'll get half off of that, $497. And then we've got some significant discounts that we are giving on the subscriptions as well, which I will go over when you guys call in and talk to me personally. So that's all for us. Okay, you can contact us directly at 1-800-883-0524. You can email us at support@forensfieldresearch.com. And my suggestion would be to go to finalturtletour.com, register for that seminar. Not only do you get to meet Russell, but you get to meet me too. It's going to be local. It's going to be in Los Angeles. So it's at the Embassy Suites, March 17th through the 19th. And again, anybody attending the webinar, you get half off the early bird special there. It'll be $900, $997. And anybody that subscribes, it'll be $497. Oh yeah, make sure you guys put in the promo code TurtleWebinar, or call in, ask for me, and I can get you signed up. All right, hope you guys are having a great day. Hope you guys have success in the markets tomorrow, and I look forward to speaking to all of you. Thank you.